Welcome to Bajaj Finance's earnings call to discuss the fourth quarter FY18 results. To discuss the results, we have on the call Mr. Rajiv Jain, who's the Managing Director, Mr. Sandeep Jain, who's CFO, Mr. Rakesh Bhatt, who's Chief Operating Officer, Mr. Atul Jain, who's now CEO of Bajaj Housing Finance, and Mr. Anup Saha, who's President Consumer Business. May I request Mr. Rajiv Jain to take us through the financial highlights, and subsequent to which we can open the floor for Q&A session. Over to you, sir.
Thank you, Karan. Thank you very much. Good afternoon to all of you. We have uploaded the investor presentation in the investor section of our website. So I'll refer to the presentation for my comments and the management commentary. If I can jump straight to slide 8 of the presentation, this is essentially the last 11-year track record of the company since we started the transformation journey. I think it's been a pretty strong full year for the company which went by, which is FY18. We ended the year with 84,000 crores of assets and profit after tax growth of 46% at 2,674 crores. So overall, year-on-year and CAGR, as you can see in the presentation, were very, very strong. Year-on-year, assets grew 40%, NI grew 43%, operating expenses in this grew 44%. That's a number that we got to track more closely as we get into the next year. Loan losses and provisions came in stronger at only 30% growth, and overall PAT grew by 46%. What gives me greatest joy in this panel is three important metrics. Return on assets after 5 years came in at 3.9%, a tad below 4%. Return on equity, despite the capital that we raised, which was a large capital raise of 4,500 crores, still came in at 20.5%. And gross NPA and net NPA performance exiting the year came in at a record low of 1.48% gross NPA and net NPA of 38 basis points. And provisioning coverage improved further to 75%. So pretty strong year for us as a company. If I may jump you to management commentary, and then I'll open it up for which is on slide 14. Essentially, as you've articulated there, that BHFL is now fully operational since February 18. Atul, who has been with the company for the last 16 years and was in the previous role as Enterprise Risk Officer, has been appointed as Chief Executive Officer. The company is run independent from Bajaj Finance, other than Treasury. Treasury supports them horizontally. Otherwise, the entire management of Bajaj Housing Finance is independent of BFL. We think with a sharper focus, the ambition is to build an industry-leading mortgage business in the next 3 to 4 year horizon. Overall, the granularity of portfolio remains an important consideration. So as part of that process, we added 215 locations in the current quarter itself, and overall we've added close to 350 odd locations in the last 1 year. And the presence now is in 1,332 locations as a company. We think that should augment growth on one hand, reduce risk on the other, and also ensure continued growth momentum for us as a company for the next few years. OPEX to NIM, as I said previously when I was talking financial commentary, that is an area I would like the number to anchor between 40 and 41%. But given that we were having a strong year, as you can see, geo expansion to investment in talent, technology, and geography has meant that the number, on a full year basis came in higher than what, by 80 basis points higher than what our forecast is, which is 41%. But it's more investment than expense. That's really how I would look at it. Headwind on this panel is the macros. while we are positioned very well as a company given our ALM, but macro is the headwind, micro is the tailwind. That's really how I look at it. The deteriorating macro could mean lower margin businesses will get impacted, but we as a company are a micro-focused company, so we should be very well placed to manage the impact of the deteriorating macro. Portfolio quality, we've added a additional panel to further improve transparency on risk matrix. That's a new panel which is page 27 that has been added. So that provides greater granularity of information in terms of risk matrix. I think it's been a very strong quarter and exit from a risk matrix standpoint. We believe as management and that risk is the engine of the growth of a company, and the engine is firing on all cylinders, given we don't even have a single yellow in the portfolio matrix that we've actually laid out to the street in this presentation. Last but not the least, we made a strategic investment in a wallet company, which is India's second largest wallet company, and created Bajaj Finance MobiKwik wallet. It's an exciting space, and we are working very closely with the company to digitize our entire franchise and augment growth as we get into the next fiscal in the next few years. So that's on page 14. If I take you for a moment to page on the franchise, which is page 16, company ended with 26.22 million customers and close to 15.5 million what we call cross-sell franchise, people that we want to do business with. It was an addition of 1 million customers just in one quarter of what we call the best customers, and overall we added 1.41 million customers. It's one of the largest retail franchise now in India, among the top 3 or 4 retail franchise in India. We back this franchise with product suite that we have. We offer one of the most diversified product suite. We back that with technology and analytics, and hopefully we can create a sustainable growth model for the next few years for the shareholders. Page 17, just retail distribution, 1332 locations, 64,500 retail points that we are doing business with. I'll just jump very quickly to slide 23, 24, essentially, and 25, overall improvement, structural improvement. Improvement in 2 areas was caused by portfolio sale of 64 crores, not a very large portfolio sale, but in the loan against property business and in the home loans business. These are the 2 areas that turned green partially due to the 64 crore portfolio sale, but as I said, the number is not very material and significant. Provisioning coverage in slide 26, and then I'll open up for questions. The consumer business gross NPA, SME, rural, very steady, and across all 3 of them improvement in the previous quarter. That's really the quarter. Page 27 is there for those who are interested in the more granular NPA data movement. That's really how the quarter is. Overall stance for the next fiscal remains reasonably strong. If the exit is strong, then the entry makes the journey easier. That's really where we are. Myself and the management is here to respond to any questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1.
Karan?
Hello, sir.
You're connected, right?
Yes, sir, Karan is there.
Can you hear me?
Yes, we can hear you.
So maybe start taking questions.
Hello?
Karan, just let me check the line for the
Yeah, I think the line got disconnected.
Participants, you are requested to stay connected while we check the line for the management. We have the line for the management reconnected. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Bharat Shah from ASK Investments. Please go ahead.
Yes, Bharat bhai. My God.
Okay, it seems Bharat's line disconnected. We'll take the next question from the line of Ronak Rajura from Asian Market Securities. Please go ahead.
Yeah. Hello.
Yeah, please go ahead.
Yeah, sir, my question is, I was just looking at your two businesses. One is the mortgage business, which is there even in the standalone,
yes.
And now that you have a dedicated housing company. So, are there any, I believe there will be advantages of actually having a housing finance company. So, do we plan to actually sell the housing, the standalone business or mortgage business which is there in the standalone entity to the housing finance company?
So fundamentally, BFL shall not do, it's a 100% subsidiary of Bajaj Finance, so that's point
right.
One. Incrementally, given we want to create a strong standalone mortgage business and given the size of the opportunity, as a strategy, we've decided that it will be run in BHFL. The 20,000 crores of balance sheet that you see as of Q4 is the portfolio which was acquired till January 2018. Since February, the entire acquisition sits in BHFL. So incrementally, all assets, BFL does not do any mortgage business, and any mortgage asset or any mortgage business is done through Bajaj Housing Finance.
Okay, so then the repayment that will happen, therefore there will be no incremental business in Bajaj Finance, and therefore the book will keep on falling,
That's
right?
Correct. That is correct.
Yeah, okay, that's it. Yeah.
We expect, if I may just add, we expect 2.5 years by which the entire transition should happen. That in 2.5, 3 years' time. I mean, depends. My sense is between 2.5 to 3 years' time, you may not see any mortgage, or if, as Sandeep is rightly saying, not a material number you may see sitting there. Majority should be sitting in.
So I get that. So my question is, therefore, there will be definitely some incremental advantages of having of doing the business under a housing finance company, right? So I understand that the sources of funding would be cheaper. You might have access to NHB funding and all.
Absolutely.
So apart from that, is there any specific advantages of getting it through a housing finance company?
Two big advantages. Given the size of the opportunity, much sharper focus, greater efficiencies in the process, and lower cost of funds. I think those are broadly the 3 points.
Okay. Thank you, sir. That's it for me. Yeah.
Thank you. The next question is from the line of Abhishek Saraf from Deutsche Bank. Please go ahead.
Yeah, hi. Thanks for taking my question. So just two questions. First on the slide on the NPA movement.
Yeah.
So so there's a sharp improvement in the rollback to standard, which probably is the upgrade thing.
Yeah.
So in which segments have you seen sharper upgrades happening? And secondly, on SMEs, so I see that the SME growth has kind of picked up from 16% last quarter to 19%.
Yes.
So how are you, I know that you have been earlier saying that you have been a bit more cautious on the SME segment.
Yes.
But do you think that, are you seeing some kind of momentum coming back because the GST thing is now behind and in the base now? And so you think that, so what is your overall view on the SME segment now going forward?
Overall view on SME is post-Demon, post-GST, things have stabilized. Last 2-3 months have been much better. So it gives us greater confidence that things seem to be normalizing.
So is it possible to, so now that probably we can see higher growth coming in because the SME book has been growing much lower than the overall book?
Yes, the answer is yes.
Okay.
Yes.
Okay.
And to answer your first question, in general, rollbacks were across. In a way, I would argue it doesn't include SME rollbacks. SME rollbacks will come back with a lag. Clearly, as if you're referring to the 96 to 140 crore rollback number, it's across, but I would just hasten to add that does not include SME rollbacks. It should come in next 2 to 3 quarters.
Sure. Sure enough, sir. Thanks a lot.
Thank you. The next question is from the line of Shubhranshu Mishra from Motilal Oswal Securities. Please go ahead.
All right. Thank you for the opportunity, sir, and congratulations on a good set of numbers. I just wanted to understand the...
Shubhranshu, you're not clearly audible. If you can be a little loud.
Hi, can you hear me now?
Yeah, we can hear you.
Sir, thank you for the opportunity. I have 2 questions. First is with respect to the housing finance business. I understand we will have access to low-cost funds and the size of the opportunity, but then if we look at the number of housing finance companies already in the market, how are we going to be any different from any of them? That's my first question. I just want to understand the architecture of the present set of business and how do you plan to tackle the competition which is there in the market already.
So look, it's not a new business for us. As you can see, it's 24,000 crores of assets versus out of the 84,000 crores of assets. Let's stay with that first. So 24 by 84, if you look at it, that's 29% of the balance sheet has always been mortgage. So that's part one. So we've been competing and doing this business for the last 9-10 years. But we do believe that so it had the relevant size and scale to be separated. In fact, one could argue that could it have been separated earlier. You know, in our minds, $2 to $3 billion is rightful size to run an independent business. Probably we are a year behind on the separation. We got the license in December 16. By the time we fully separated, as we just mentioned, from January 17. So it was clear to us in our heads that this needs to be run separately, requiring much sharper focus. While we don't do segmental reporting, suffice to say that we can do a much better job on mortgages that we've done so far. And we thought that a sharper focus and independent management would be able to do that better than it sitting as a strategic business unit within the company. And that's really the reason we took the decision to do this. And we are personally quite excited. I would not ask a baby who's just who's just been born, it was born 3 months ago, difficult questions. We agree. The baby has been told that you're in a difficult place. Baby has been told that expectations are to build an industry-leading mortgage business. And we are confident that the baby shall deliver in the next 2 to 3 years' time.
Right. Well, thank you for that. But still, the architecture of the strategy, at least for the next 12 months?
No, it's a valid point. So I have consistently articulated that we fundamentally have, out of the 26 million franchise that we have, out of 23 lakh crores of mortgage assets in India, our customer franchise has close to 6.5 lakh crores of mortgage loans. Okay?
Okay.
That's a distinct difference we bring to the table. Who owns a home, what is his repayment has been, that has been one part of the model. On top of it, we have a base of 60 million customers that we want to do business with. We take this franchise of 26 million and the 60 million prospects that we've aggregated over the last few years and take that to build risk models on them, pre-approve those clients, take them to the developers and generate velocity. Now, nobody has done that in the industry. The largest mortgage guy would have probably 500,000 customers. Okay. So I'm just giving you one expression of the differentiated proposition that we expect the baby to deliver on.
Okay. So this is for the next 12 months. My specific question is for next 12 months.
No, it's the mortgage businesses are not delivered in 12 months. It's a 24 to 36 months view. It should not take that longer given that we run this business, but to deliver industry, when I am referring to 24 to 36 months, I mean industry-leading matrix, they would require 24 to 36 months. Right, and you would see improvement every quarter from here on because, as I said, we run this business for the last 9 years. It's not like a new business for us.
Sure. And second is with respect to the rural franchisee that you own, and the focus has been on increasing the rural franchisee instead of rural branches. So how do we look at the rural business as such going forward?
Rural business we are quite excited by. I think both in terms of aspirations of the rural mass affluent, our distribution footprint, the opportunity there. 602 branches are only in top 10 states in India. Ambition would be to be in at least 16, 17 states in India, which what I would call must be present in. But rural is a double-edged sword. You expand too rapidly, you are in trouble. You slowly is not a problem, but it's an opportunity loss. So as we gain greater confidence in expanding the footprint and manage the risk, you should see us continue to accelerate. It's grown YOY 100% for the last 2 years, and we are quite excited about the rural lending business.
Sure. Thank you. I'll come back in the queue.
Thank you. The next question is from the line of Bharat Shah from ASK Group. Please go ahead.
Hi, Rajiv. I don't have any question to ask, but I just wanted to make 2 statements. One, the deep sense of gratitude for what Bajaj Finance has done to our client portfolios over 9 years. And second, very strong congratulations not to you and your team, because this is not an easy business, though the results of Bajaj Finance look effortlessly superior, but it's a tough business which is managed fantastically well. So superior growth without compromising on quality of the growth and the risk metrics is an outstanding achievement. So hearty congratulations.
I would only just say one, thank you, Manoj. Thank you. I would just say that we are not resting on our laurels. I think the management and the 14,000 people of the company continue to make effort to raise its bar. I think that's the spirit of the company, and we hope that the shareholders never found us wanting on that cultural dimension, which does not get represented in the numbers, if I may say so.
Absolutely. And I'll expect nothing ever less than this from you and Bajaj Finance.
61% growth is an exception. That's all.
I didn't mean just the growth rate. I mean the overall quality of the performance.
Yes, very much, very much. Yes, Thank you. It's a reasonable commitment to the shareholders.
Thank you.
Thank you.
Thank you. The next question is from the line of Umang Shah from HSBC Securities. Please go ahead.
Hi. Congratulations to the team for a great quarter and a great year. I just have two questions. One is on the mortgage business that do we have a particular size in mind 2 to 3 years down the line as to how big our mortgage business would be? So currently we are about 29% of total, as you said. How big could be the business in next 2 to 3 years, and what would be the consolidated ROA by then?
So look, you are absolutely right. Its contribution to the overall balance sheet ought to grow, because otherwise no point in separation and independent and a sharper focus. I would just, Umang, wait for a little while for the management team to settle in, and then raise the bar on how they, what we expect from them. I think we are just, its contribution at the peak of it, if I may say so, when LAP was a growing business, Umang, the mortgage contribution was 37%. Okay.
Right.
Today it's down to 28-29%. So should we get back to 35-37% of the balance sheet as a company in the next 2 to 3 years' time? The answer is yes. And of course on expanded balance sheet, right? So that,
right,
if you were to multiply the numbers, should create a reasonably large business for us as a company. But industry leading metrics, that's the core, that's a bigger focus rather than just the size. This business has to be of size and scale. We are very clear about that. That's a separation, but without any compromise on industry-leading metrics.
Understood. But that is exactly the reason why I asked the question that, let's say 3 years down the line, should one expect that the consolidated ROAs still remain in the vicinity of 3%? The reason being that because in the interim there we may see some aberrations because let's say if the LAP and the mortgage business on our balance sheet keeps running down and it keeps building on the housing portfolio, there could be some aberrations between standalone and consolidated. But is a 3% ROA a fair expectation for the consol balance sheet?
We are committed to deliver that to the shareholders. It's 18 to 20% ROE on a consolidated basis and a 3% ROA. We outperform, that's for shareholders to take. But we shall not deliver a lower than 3% return on assets to our shareholders.
Fair point. And just one more question related to this. So incrementally, even the LAP business will happen in the HFC or we...
Everything in HFC. Because the model doesn't work. You have to do salaried mortgages, self-employed mortgages, loan against property, developer finance. Lease rental discounting. A rightful mix of them delivers a rightful ROA and ROE on a standalone basis. So there was no option but to run a full service mortgage business out of the HFL.
Which means the rundown on our balance sheet may look a little aggravated in the near term.
Answer is yes.
Okay.
And the right thing to do would be to look at consolidated. We had chosen, we didn't have the benefit of, now we have the benefit of hindsight. We've now chosen quarterly reporting on consolidated and standalone. So from first quarter itself, you will start to see the numbers separately.
Perfect. And just last question on MobiKwik, how much do we own currently, and do we have any plans of any incremental investments in MobiKwik?
6% we own. As it becomes more and more strategic, we will evaluate.
Okay. All right. Thank you and wish you all the best.
Thank you.
Thank you. The next question is from the line of Utsav Gogiraj from Investec Capital. Please go ahead.
Thanks for the opportunity, sir. So my question is again regarding to the housing business. Since the interest rates are increasing, just wanted to understand how do you look at the cost of borrowing for the new entity, and how do you want to maintain the spread in that business? Just wanted to hear macro, the impact on the cost of borrowing, and how do you want to hedge it?
So it is a headwind. Lower margin businesses are, so as I was saying as part of my media interactions, that macro is deteriorating, micro is improving. That's really how I look at it. Start from crude, go to dollar, go to CAD, go to CPI. It's a deteriorating macro at this point in time. Highly likely interest rates will be increased by, the headline rates will be increased, even where all the first three that I mentioned are going. So macro is deteriorating, micro is improving. Discretionary consumption of most companies who publish results seem buoyancy in volumes. April has been a good month for two-wheeler. April has been a decent month for passenger vehicle. April has been a strong month for commercial vehicle. So net, improving micro has then two parts. The consumer discretionary part of the game, which is our B2B businesses, the B2C businesses, SME businesses are less impacted. Clearly, lower margin businesses like the commercial businesses and the mortgage businesses are more impacted. Very clearly. Now, if you look at the behavioralized maturity that we have put out in the public domain as part of our investor deck, would see that we are reasonably well covered on our long-term, on our behavioralized maturity. So, summarize to say that we should be amongst the least impacted. Will there be an impact? The answer is yes, but we should be far less impacted than otherwise. On the more specific point of mortgage business, it's a headwind. I agree, because our plan 2 months ago was that we'll be able to navigate this better. So in a way, they are in it's a more stormy situation than they would have liked themselves to be in. But that's for management to handle and deliver. So can't do much about it. We'll navigate this. Does that answer?
Sure. Thank you, sir.
Thank you. The next question is from the line of Omkar Kulkarni, individual investor. Please go ahead.
Hello.
Yes.
Yeah, my question was, if you see slide 17 about distribution network.
Yes.
The rural distribution has been increasing, even the urban has been increasing, but in the last financial year, the pace of growth has decreased. Is there any reason for that, or is it you are doing it for any purpose?
The pace of growth is increased, isn't it? 25,000 has gone to 40, 40 has gone to 64. You mean the total, Omkar?
No, I mean it was 14,000 and now it is 15,500. Still it is a growth, but the pace of growth has decreased.
So look, every incremental branch expansion, if you see the top, 377 urban is looking at 730. Outside of 120 markets in general, there are only 5, 6, 7 distribution points. So the location distribution may expand, but not the exact footprint of the stores that we are present in. So that's one part. The other part of it you have to see is that we have now separated the digital product stores. Okay,
right.
They used to be together. 6,000 has gone to 16,000 if you see.
Right.
So if you take 120 plus markets, you may have only 4 or 5 consumer durable stores, only 2, 3 furniture stores, but you may have 50, 60 mobile stores. So that's how you need to see the distribution footprint.
Right.
Does that answer?
Yeah, sure. And one more longer-term question. Whenever we look at a company's growth, we look for longevity of growth. And you have been demonstrating that for last 10 years, upwards of 35% growth.
Yes.
So, given the size of opportunity you talked about, you are just 1% of the entire credit system.
Yes.
And I guess the HDFC Bank is around 10 to 12% of the entire system.
Right.
You have huge runway for growth. So, apart from, last time you mentioned that greed could derail the growth.
Sorry?
Greed. Greed.
Yes.
Yeah, greed. Apart from greed and higher base, what could derail the growth of Bajaj Finance?
What I was telling Mr. Bharat, if the culture of the company was to dilute the spirit of wanting to continue to raise the bar, that can also derail. Greed can derail. The spirit which has brought the company to where it is can derail. And we are committed to not dilute any of them.
Yeah, but isn't there any other risk to Bajaj Finance?
Risk. We are an operating business. We are an operating company. Demon was a risk. GST was a risk. There are event risks that we cannot predict. Answer is only twofold. As I said earlier, remember we are a risk business. Ensure culture remains tightly coupled. Third and important point is continue to focus on granularity of the portfolio. Right. More granular we are, less is the event risk we'll be exposed to. More concentrated we are, higher is the event risk we'll be exposed to. So that's why if you see the distribution footprint expansion, we want to be in 2,000 cities and towns in India. Not for growth alone, for granularity. We want to deal with the customer more and more directly, less and less through intermediaries. Not because intermediaries are bad, because we want to own the customer. So those are some of the dimensions. You can get an offline call with me or Sandeep or any of us. We can take you through some more texture.
Because it becomes real.
Omkar, I'm sorry to interrupt, but maybe request you to come back in.
Yeah, that's what I'm saying. Offline, if you can come back.
Thank you. The next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations to the management for a phenomenal quarter and a year. Just two questions, Rajiv, on the BHFL. In the notes, we have mentioned that we have invested 1,200 crores in the subsidiary. So the first question is, apart from this infusion, do we need to infuse any capital in the next 12 months?
800 to 1,000 crores, depending on the velocity, sometime by October, November.
How much? I saw you missed.
7,000 crores.
7,000 crores.
1,000 crores.
1,000 crores.
Fiscal.
Okay, that would be equity only.
Yeah, only equity, yes.
Okay. And given that this infusion is coming in this subsidiary and the phenomenal growth we are seeing in our businesses, we have raised capital in last year. So till what time? I mean, as you mentioned that this would this whole structure will release capital also, given that it optimizes ratios for the company. Do we need to sort of raise capital in next, say, 18 to 24 months?
No. I would go longer than that, probably not for three years plus, sitting here.
Okay.
We are very comfortably placed. What I mentioned, that it does give us greater capital efficiency. Our idea is not to create a levered play, but without doing that, just the benefit of the sub would ensure that we are pushed out. If you had raised capital in 3 years, this pushes it out to at least 4 years.
Okay,
so
and
we are quite comfortably placed.
And do we always want to remain 100? This subsidiary would remain 100% subsidiary.
Management is to deliver, and then we'll take decisions.
Perfect. And then just lastly, Rajiv, was on this. We've always mentioned about the franchisee of Bajaj Finance in terms of customers. In the latest presentation by Bajaj Finance, they've talked about the consolidated, the group franchisee. Just to cross sell to that. I mean, what are the how we are sort of cross-selling to the entire Bajaj Group franchisee, because I think that number is quite big, closer to 146 million. As on December. So how we are trying to leverage
those customers who consented that they can be sold a product? We essentially put them into an independent infrastructure, which ensures that by regulation they are not compromised. And then we create propositions for them to purchase. That's really how it is.
Okay. That will be all. So thanks for the answers, Rajiv, and congratulations once more, and all the best for the next quarter.
Thank you.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
No, thank you. My questions have been answered.
Okay. Thank you. The next question is from the line of Jeetu Punjabi from EM Capital Advisors. Please go ahead.
Hi, Rajiv.
Hi, Jeetu.
Rajiv, two questions, right? You alluded to this earlier that the last 3-4 months you've seen growth momentum come back, and despite the macro stroke micro playing headwind stroke tailwind, things have worked out well in the last quarter. Do you see this momentum that you've seen in the last 3-4 months, do you expect it to continue?
I can't say yes, I can't say no, Jeetu. What I would say is, I think after 5 quarters there is a degree of momentum that we are seeing. So if you want to convert that into a yes, probably yes.
Got it. Okay. The second question, right?
Yeah.
Which is, for whatever reason, if things slow down, and I'm not saying this quarter, next quarter, it doesn't matter. Whenever things slow down, would you see a deterioration in some of the key metrics? Would you see a deterioration in some of the key metrics in terms of asset quality and ROAs or anything? I mean, anywhere you would see deterioration in the metrics?
No, we are very comfortably placed entering the new fiscal, Jeetu.
Okay, lovely. Thanks so much. Keep chugging away. Good luck.
Thank you.
Thank you. The next question is from the line of Sonia Lalwani from Purnartha Investment Advisory. Please go ahead.
Hi, sir.
Hi.
Congratulations on an excellent set of numbers. So just had 2 questions on the geography. Wanted to ask how you're planning for increasing your distribution network going ahead in 1 to 2 years span.
So fundamentally our entire distribution is anchored around physical footprint being expanded. Of course, we have reasonably strong digital presence as well, but you should expect to see 1,332 locations increase to 1,550 or so by March 19. It also depends on how our profit momentum is. If our profit growth momentum is stronger, it could be stronger. If it's a little softer, then we would delay it. But you should expect 1,332 locations to at least get to 1,550. And then as a result, the downstream physical footprint to also expand in the next fiscal.
Okay. So second question is on the geographical presence. In which states you are majorly planning of the expansion, and currently in which states you have the most branches or most franchises located?
So look, fundamentally, we are, it's pan-India footprint, number one. Clearly, 1,332 locations, it's with the purpose of optimizing our investment. So clearly we pick the easy ones. Easy states first, which means more prosperous states, better human development index, better banking penetration, and so on and so forth. As we as we further increase penetration, it's not dilutive, but it's not that accretive. So it's what we call now deep geo, which is deeper distribution in state to ensure better controllership is really where we are headed. So that's the thought process.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Ravi Srivastava from Bay Capital. Please go ahead.
Hi, sir. Congratulations on a great set of numbers. I had a couple of questions. One was on the customer franchise slide that you have.
Yeah.
Just wanted to understand this. We have an overall cross-sell franchise of 18.88 million and non-delinquent customers have 17.22 million. Does that mean that the differences of customers who have been delinquent?
Those who have defaulted ever.
Including bounce.
Yeah. So
okay.
When I say default, that's what I mean for them. Bounce is even though. Okay. So what Atul is clarifying to me is, so the answer is yes. The 19 million is overall cross-sellable franchise.
Yeah.
So 18.88 to 17.22, these are clients who have paid us, but when I use the word defaulted, Atul is clarifying, it's bounce, which means you took a loan, you did not honor your installment, we went and collected, you may have paid us immediately.
Okay.
But based on the risk models, in some cases we may call you cross-sell, some cases we may not. So it depends also based on our risk assessment and so on and so forth. But simpler answer is yes. Those who have defaulted on us or bounced on us and the rest who have not.
So does that worry you because this number is almost 9% of the total cross-sell franchise? Is that something that we should worry about?
It should give you peace that it's a very tight metric we run. That the more tighter funnel you see means more risk prudent we are. We can make this into a rectangle or a square. You want to give to 26 million customers irrespective of whether they paid us or not.
Right.
Narrower the funnel or more inverted the pyramid, better off you are. Which means our entire focus is on 15.5 million customers, good with us, good in market. We would love to do business with them. That's really how our repurchase rate. Then we open all doors for them. If I mix up, if I say, look, on 19 also I can take some exposure on, or on 17.5 itself I can take exposure on, I'm starting to mix up. The moment I then mix up, then I could see outcomes which may not be consistent with what I estimated it to be. So, sharper focus on risk, but then open the doors. That's the view.
Got it. So, second question is on the competitive scenario in general. So I see now wherever you used to compete, for example, on Flipkart or on Amazon, it used to be only Bajaj Finance offering a 3-month, 6-month, 9-month zero EMI, which is now given by HDFCs and others as well. So how do you see competition coming in, and does this growth is going to see challenge in the future?
So look, we've never looked at competition and built our business. We fundamentally continue to compete with us. Clearly, that as a result, category expansion, doing more business with our customers has been the approach. 59% of the loans that we did in the previous quarter came from existing franchise. 26.5 million customer franchise would be among the top, among private sector banks, probably the third or the fourth largest consumer franchise in India. And just keep doing more with them gives me a 60% higher run rate. 40% I can handle by granularity. Outside of 120 branches, competition fundamentally just dissipates because it's very hard to do business there. So that's been our approach to building the business, and we continue to do that.
Fantastic, sir. Great.
Thank you.
Thank you so much.
Thank you. The next question is from the line of Subramaniam Iyer from Morgan Stanley. Please go ahead.
Hi, Rajiv. Congratulations on a great set of numbers.
Thank you.
My first question is on the consumer durables financing piece. So, an investor already alluded to the competition in that space.
Yeah.
So, my question is that your new to Bajaj remains quite strong. What's the share of new to credit in that? And as you become a larger entity, and given that you are diversifying geographically, will this new to credit share go up in new to Bajaj? That's the first question.
Likely. Subbu, let me give you some texture. I mean, if you assume that Bombay has 7.5 million households, 75 million households. That's correct. 75 lakh households, na? 2.5 crore की population है, 7.5 million households हैं, 7.5 million households, 2.8 million are my customers, Subbu.
Okay.
I'm giving you real hearts, which means 1/3 of Bombay households are my customer. We assume Bangalore to be 5.5 million households. Okay. 55 lakh, right? Yeah, the 1.5 crore की population. 1.9 million households are our customer. So clearly, even leave competition aside, right, for a moment. Hello?
Hello, yeah.
Leave competition aside, and having lent to millions of customers. So one part is that. I'm not even talking competition. The second order point is 35% of the customers continue to be, for last many years, new to credit, which means don't have bureau scores. If we cannot underwrite and score a new to credit customer, then who can? So it's not like just competition has come in, so we're seeing that shift. 35% of the customers have remained new to credit. And we have lent to millions of customers. We know how to score them. If at all anything, year on year, ability to do that continues to improve. So we don't see structurally any big shift in the last 3 years that we saw. If you ask me 3 years and prior, yes, there is a shift. In the last 3 years, no. Does that answer your question?
Yeah, great. That answers. My second question is basically on the personal unsecured loans front, which is obviously a big profit pool for you. We are increasingly seeing a lot of digital lending options coming up, offering loans at 11%. So how do you see the scenario there?
I've been hearing about it for the last 3-4 years. Fintechs, startups. Okay. At 11% leave online, I would not do a loan or offline. Because anybody who's done an 11% personal loan has eventually gone to the grave. Okay. Risk adjusted, if this business is not done at a gross margin of 6.5%, 7%, which means if you take 8% as the cost of fund, if you do it at anything less than 13.5%, 14%, you're going to be eventually going to grave. So there are offline players and there are online players who do this at that rate. Then they are missing the point that it's a profit pool. It's not a balance sheet builder. You're not going to find us do that. And the answer on the other hand is, this whole digital lending is about go in, input information and so on and so forth. We walked away from that. We are rapidly moving in the direction that I would find Subramaniam Iyer, pre-approve Subramaniam Iyer, and tell him to just go onto the website, key in his mobile number and find his pre-approved loan and just say yes, and he would get a call, and if he is the best customer, money dispensed in 10 minutes. Period. So this whole era of digital lending, which is led by what I call application, form fill and rule engine, is a passé, at least to us as a company. And I think industry is reasonably far behind on that metric, if I sound pompous in saying it, but that's our view.
Great. And one last question on your tie-up with MobiKwik. So MobiKwik obviously has a large customer base, reportedly about 65 million. So what is the intent?
Sorry. No, as I answered, I mean, as they build out, as our strategic partnership deepens, and as it becomes more central to our consumer business strategy, we will respond appropriately.
Great. Thank you.
Thank you. Thanks.
Thank you. As there are no further questions, I now hand the conference over Mr. Kunal Karan Singh for closing comments.
Yeah, on behalf of JM Financial, I would like to thank Mr. Rajiv Jain and the senior management team of Bajaj Finance and Bajaj Housing Finance and all the participants for joining us on the call today.